There's a difference between headline inflation, which we hear about all the time, and core inflation. And this isn't so widely followed by the masses out there, but the Bank of Canada watches this core inflation very, very carefully. Now, this morning, Canada's latest inflation numbers came out. We saw January tick up to 1.9%. That's up from 1.8% in December. And this is not a huge jump. It is now the 6th month in a row that inflation has stayed at or below the Bank of Canada's 2% target rate. Normally, I would say that's a pretty big deal because it does give the Bank of Canada more room when they contemplate whether they're going to be cutting interest rates. But this time around, we saw those two core inflation numbers go up, and that does kind of throw a wrench into the bank's plans. I'm going to talk more about that in just a minute here. But for now, I just want to break down the headlines for today. So as I mentioned, headline inflation came in at 1.9%. That's up from 1.8% in December. And here's an important part of that headline. Transportation costs jumped 3.4% in January compared to 2.3% in December. And the big part of that was gasoline prices, which jumped 8.6%. Now, I filled up my tank recently in the little town I live in here, and I definitely did notice the higher gas prices. Now, we also saw passenger vehicle prices rise 0.4%. Now, that's not a massive increase, but it is actually the first time now in 8 months that car prices have gone up year over year. Now, on the flip side to that, we saw shelter costs. They held steady at 4.5% on an annual basis. Food prices actually dropped 0.6% after rising the same amount back in December. So let's dig into this a little bit now. I want to focus on the jump in transportation costs because that is a reminder to us of how volatile energy prices can be. And for investors, of course, that volatility can create opportunities in the energy sector, but it also poses risks if you're heavily invested in certain industries that are sensitive to those fuel costs. I think of transportation and logistics, for example. Now, I also note the stability in shelter costs, and that's very interesting. Even though housing affordability here is still a pretty hot topic in Canada, this steady rate of 4.5% is maybe a sign that the market isn't spiraling out of control, at least not yet. Now, one more thing that really stands out to me is the rise in the core inflation numbers. I want to get a little more detail into this. So when we look at the CPI trimmed mean year over year, that rose to 2.7% and core inflation climbed to 2.1%. So while headline inflation looks pretty stable, these core numbers that strip out the more volatile items like food and energy, they can give us a clearer view of the underlying inflation trends. And this rise to me suggests that the inflationary pressures haven't fully gone away, and that's concerning because it might put a stop on how far the Bank of Canada can cut interest rates. If core inflation stays elevated, the bank might need to pause or even possibly reverse cuts sooner than expected. Now, when we look at the impact that this has on policy, the markets, or businesses, here's where things get really interesting for investors. Inflation holding now below that 2%, that does definitely support the belief that the Bank of Canada will continue cutting interest rates. They've already made 6 consecutive cuts, bringing the rate down to 3%. Now, lower rates, of course, mean cheaper borrowing costs. That can be a boost for stocks. But not everyone is convinced that that trend is going to continue, and I probably fall more into that camp. In my opinion, the Bank of Canada might be sort of between a rock and a hard place here. If the underlying inflation, like the core median, the trimmed mean rates, if they remain high, and you can see that on this chart here, then cutting rates too aggressively could just reignite inflation, and that's not a good thing for any of us. That's something to keep an eye on because it could mean rate hikes later down the road, and that generally isn't a great thing for the markets. So what does this all mean if you're investing in Canada right now? Well, honestly, I do believe that we're sort of in that sweet spot, at least for the time being. We see inflation that's stable, interest rates are coming down, and that's generally positive for stocks, for real estate. But that core inflation is still a little bit too warm for my personal comfort level. I'd be cautious about getting too aggressive with any interest-sensitive stocks just yet. Now, rate cuts obviously are good news, but if inflation does creep back up, the Bank of Canada is going to have no choice really to suspend the cuts they're making, or in a worst case scenario, maybe reverse course, and that, of course, would hit the markets pretty hard. Now, looking ahead, there's one thing that I am watching very closely, and that is the trade tensions, especially, of course, with the U.S. That's another wild card that could disrupt the supply chains and push prices higher. For Canadian investors, I think that the next few months are going to be pretty critical. If inflation stays tame, if the Bank of Canada keeps cutting rates, then we could see more strength in the stock market, potentially in the housing market as well. But if inflation starts heating up again, then I would say all bets are off. What do you think on this? Are you feeling optimistic about the Canadian market with rates coming down, or are you worried that inflation might come back to bite us? Drop your thoughts in the comments. I'd love to hear your take. As always, thank you for watching. We'll see you again soon.